Ready? All right, I think we're back in action again now. So, first off, my name is Chris Swift. I'm with Swift Trading Company in Nashville, Tennessee. I certainly do appreciate all of you joining me this afternoon for a little comments on some recognition of the subtle changes that we've seen in the cattle market, the mentality of the producer from the losses that we've seen over the last couple of years, and maybe what to do under the current circumstances that we're in. So we're going to start it off right here, and we're going to start off with the weekly live cattle chart. And as you can see, we have our first five-way move up in the market that we have had since we started this decline in November of 14. This five-way move up may or may not be completed yet, and as you can see, even today, although this is not the end of the week, so this won't actually solidify until Friday's close, but if we were to close above 119, it would be a new high close in the weekly, and it may or may not have some bearing on this last move up or the wave count. More likely than not, if we were to close above 119 on Friday, I would say that this current move up is going to be part of an irregular B wave. So we can already see that we have the 5 waves up to the 119 level, being our wave 1. Wave 2 will historically either unfold in a 3-wave, down, up, down, or a 5-wave sideways pattern in which a trend channel, sideways trend channel can be formed. In this particular case, we don't know yet which one it's going to be, but what it does tell me is that I need to be overly cautious about being too bullish on this. I already have a 5-wave move up. I could have small variations in it that could create another $2 to $3 rally that wouldn't necessarily change this wave count at all. So some of the things that we're looking at that caused this rally: we got fewer numbers of cattle on feed, that we started placing lower placements in August. Now we come to the future, and we are sitting here looking at lower placements that has helped to reduce total beef production. The carcass weights, and although the carcass weights have come down dramatically year over year, even the last 5 or 6 months they've come down slightly. But just the recognition of getting rid of the big 1550, 1575, and 1600-pound cattle that have been showing up on the show list, a majority of those are gone. So just from a reduction in, just from a psychological standpoint, not seeing those great big heavy cattle on the show list anymore is having a good effect on the market. And we've had improved demand. We have seen some increase in demand. Grocers and retailers continue to have very solid promotions for their advertisements. We've noticed that the grocery stores have tailed off just a little bit after the Christmas season, but they had such a good Christmas season, I think they will want to replenish those shelves and keep that inventory, keep those meat shelves full with inventory. Export demands continue to grow slightly. All of these things are just subtle changes, and what I recognize more than anything, those subtle changes come in about once every week, once every 2 weeks. We begin to see something else that just reduces the bearishness of the market, which so far has been all supply. That's what we have noticed more than anything over the last 6 to 12 months, is that the supply issues are what most people look at. Because it's easy. It's easy to look out there and see the numbers and say, well, there's more numbers than there were last year, or there are fewer numbers than there are last year. In this case, most in the industry anticipate an increase in numbers coming in 2017. I don't discount that. What I don't know, and what very few people know, is by how much. But some of the subtle changes that we have seen taking place so far lead me to believe that we would have to see a significant increase in numbers, as well as going back to increasing those carcass weights to produce the same amount, if not more, beef production total for 17 that we saw in 16. So we may have some slightly larger, but I think that with the increase in demand and some of the slowing down of the expansion should give these subtle changes the room to keep prices from moving down to a new contract low. And when we get into hedging this market, I'll show you some examples, and none of them really reflect the ability to go to new contract low. If that were to happen, then I think by that time we would either have seen some changes fundamentally having taken place to negate these subtle changes that we've seen, or there is a new instance, a new piece of news that has come up in the market that tends to be excessively more bearish than what we have seen already. So we kind of touched on what the recognition of these subtle changes are. Being a broker, I get to listen to all different kinds of producers. That sometimes gives me an edge, sometimes it doesn't. But what I hear more often is I don't want to make the same mistake this year as what I made last year, either not hedging enough. And my opinion of that only is, yes, I agree. You should take advantage of every opportunity that is presented to you. However, I think this 2017 is going to be different. In 2016, I had foreseen that we were probably going to trade a sideways market and try to allow this market to give us some time to allow producers to move one way or the other to kind of shore up some of this oversupply that we've got. Long about end of August, we started to see that tip lower because of increased numbers that we had on feed, as well as increased carcass weights. So the market took another dive. The market price pretty much told us not to do that anymore, that with the demand that we have on hand, if we were to curtail supply by just a little bit, which we've seen that's all we've done is curtail supply by just a little bit, price should rise back up. So I understand that you don't want to repeat last year, but I'm not sure that this year is going to be the same as last year. I understand that we're looking for more numbers. But what I don't think is you will go into the same growing practices as we saw to get the carcass weights up heavier and heavier. At least I hope that producers will not keep doing that and shoveling in cheap corn just to make up the weight difference, because we know that pounds make dollars, but a lot of times too many pounds makes cents instead of dollars. So this is not last year. We've already seen a significant increase in open interest, close to 65,000 contracts from just 2 months ago low, hanging around the 250,000 area. We're up to 315,000 contracts. That has been a fairly consistent day in, day out increase of open interest. I can't imagine open interest increasing, people believing this market is still going to go down. I think this open interest increase is people seeing value in the futures market with the cash market at the elevated level. We've been trading a positive basis for a while. I don't think we're going to stop trading a positive basis anytime soon. If we were going to stop trading a positive basis, I feel certain what we would be seeing is something happening in the future that can't be taken advantage of at the forefront right now. As in, a big snowstorm comes in tomorrow and blankets cattle country, and we can't get any cash trading done, but the futures can. So the futures take off and run $3, $4, $5 higher until the cash market can trade again. So I don't see anything like that that would give traders the idea that I can put the futures market up believing that the cash market is going to find the fundamentals to come and get it. I believe we'll trade much more like what we saw last week when we saw the elevated trade on the Fed cattle exchange at 118, and we saw the same amount of trade on the remainder of the cattle that we traded that week, and the futures tapered off. Everyone knows that those cattle are not deliverable until February on the futures, and a lot of things can change between today and then, hence the positive basis widen. Then as the cash market remains strong and is anticipated to probably start at 118 to 119 tomorrow on the Fed cattle exchange, the futures had too much of a discount, and we see the futures take that slack up. So one thing to watch out for, and part of the mentality of the producer, is to always remember we should keep this positive basis throughout the year, especially once you get past April, because it would be very, very difficult, I think, to be able to pull bases in June, August, or October with the current discounts that we have. So, and then I'm going to touch on, at the end of this, I'm going to touch on what do we do under the current circumstances. So we've already seen the 5-wave move up on the futures on the weekly close-only chart. This is the April futures. And we can see that the March high, we've already exceeded the August high, which was a target that I had for an objective 2 or 3 weeks ago. So we've already exceeded that. We have new highs in price, but you do not have new highs in the oscillator. We see that the oscillator readings continue to be weaker while the price goes higher. That's another clue that this market may be weakening. We can also see that the stochastics have turned twice from elevated levels. We've not seen that anywhere else going back through history on this where we have started to turn. Another subtle change to mark in your memory bank there. So somewhere around the 122 level is where I think April might be able to get up to on this move. For the June contract, at same price level, well, right now, what I'm getting for the June contract, this is, I'm going to backtrack one step. Got too far ahead of myself. When I was discussing the positive basis, this is an example of the positive basis for $10.80 using a 118 cash trade from last week as our basis. I think it will be very difficult to get that particular June contract up above the cash market. When I said that I think the reason we're not going to go down is that there is value in the futures market, this is what I'm discussing. We see June at 107.20. And if we were to think that we were going to go back to heavier numbers at heavier weights, and we knocked this market back all the way from the current 118 cash trade all the way back down to 105. Well, the value here, we're only $2.20 too high on the June contract if we were to see a $13 decline in the market. Not that I think we're going to or we are not going to, but it just looks to me like under an instance like this that it would be very difficult to say that there is not value in the futures contract over what the cash is trading. That same way as in the August contract with a $14.95 positive basis. When we noted the increase in open interest, commodity funds and index funds have been noted as the buyers in that. When I assume when they are looking at value, they are saying, you know what, at the worst possible case we had with huge carcass weights and unbelievable numbers to have to go through, $98 was the lowest cash trade that we had. Those were under the most extreme cases that we have had for supply so far. If those cases do not mimic themselves again, then potentially the true value for cattle is somewhere north of 108. That's what I kind of think is because instantly when we moved off at 98, we went to 108 so far, I think within less than 2 to 3 weeks, and then have been able to remain above that ever since. So if we were to get back in the same position as where we were, I would look for somewhere between 108 and 98 being the lower end of it, which still makes these particular contract months of June, August, Oct, and Dec very friendly towards market. So to move over into the feeder cattle market, we clearly know that this is not a bull market in feeder cattle, and I am still remain a little skeptical that it is actually turned into a bull, that the bear market is over with yet. We do have a five-wave move up, similar to what we saw in the weekly on the fat cattle, but not near the price gains is what we've seen. Because this is not a bull market, and this is not a bullish situation in any way, shape, form, or fashion for feeder cattle. There are no shortage of feeder cattle, and with the discounts in the June, August, and October fat cattle, there's no incentive to bid up for them yet. There may become incentive as those back months begin to move higher, especially if we start to see the fat cattle futures pushing higher than what the feeder cattle can day in and day out. So our first step that we're going to be looking for really on the feeder cattle is about 137.42. That seems like quite a bit of a stretch right now, considering we're 129 in the March contract and still got discounts as we move on from those. So here's our March feeder cattle, and we see the 5-wave move up on them. And I drew the Fibonacci projections, which from the Elliott wave, it suggests that the 5th wave should be equal to the length of inception to the 3rd wave times 0.618 added on to the wave 4 low. So that's what I did. I measured from contract low to what I perceive as the wave 3 high, times that by 0.618 and added that number onto the wave 4 low, 122.92, and it projects a 133.20 high. That's the target that I would be looking for. Note that it is still up underneath the August high that we saw last year. I believe this would be a real stretch for the March contract. However, that's only $4 from where we are right now. So it's not going to be too awful hard. If we had another limit up day yesterday, we could limit up day tomorrow, we could actually see that. But you can see the oscillator tapered off a lot further than what it did in the fat cattle, and although it is turned up today, still the same divergence in there. What I don't want to do is get overly excited about thinking that this market could go up and up and up. The leveling off of that point is I also don't think that we're going to go down and set new contract lows. This is the April feeder cattle contract, just to give you an example a bit. Still well below the August highs. Here's the May feeder cattle, way below the August highs. And then this is the basis against the August. I thought this was interesting for 2 reasons. One, I saw the August contract go premium over the May. That's a first for a long time that we have not seen a back month futures contract go premium to any front months in the last 18, 19 months. This time we did. Note that the lowest point of that basis is $4.30. Right now we closed today at $4.47. It's real possible we could go to an even basis real quickly. If we do go to an even basis, it kind of upsets the advantage that either the producers or the purveyors may have in this. There is no premium or discounts out in the future in order to try to attract or acquire. So that 447, if we start breaking below 430 and start trading narrower that positive basis, we may end up at around even basis for a couple of weeks. And then this is just the August feeder cattle contract, which is very near a new contract high. That current contract high for the August is 129.47. Today's high 128.97. You're 50 cents from a new contract high. That may start to begin to start bringing in some new buyers to that. We've not seen any increase in open interest in the feeder cattle comparative to what the fat cattle market has. So we'll move on to a couple of strategies. And we're going to do the first one in the March feeder cattle, and this is a comparison. The one on the left-hand side is an example of the synthetic short futures. I looked this afternoon at the premiums on it. If you buy the March 129 at 380, sell the March 137 at 115, the premium paid is $2.65. This would give you a floor of a minimum sale price of $126.35. And if you notice where that is right in the middle of all the upper congestion that we had prior to this last move up. So for producers that didn't do anything in this time frame, had you done something in this time frame, your actually sales or your minimum floor prices are a little bit lower. But if you do them now with this recent increase, you can have them right up in here. The trade-off, if you look over here on the right, the example on the bear put spread, you're paying the same premium. The difference between them is the synthetic short futures is a margin position. It entails unlimited profit potential with unlimited loss potential. You can meet margins all the way up to infinity if it starts to go up. In the bear put spread, it is only the premium that you pay for the option that you are 100% at risk for. The trade-off being, instead of an unlimited profit for an unlimited loss, you have a limited profit potential, you have a limited loss position, but you have an unlimited profit position in the cash market once you exceed the $2.85 premium, $2.65 premium. Once the cash market begins to trade another $2.65 higher, that money is the same as what you would have spent. Anything over and above that, it's yours to keep, with the floor still in place. If something were to wake up one morning and happen bad, you still got that floor in place. Either one of these, I really don't have much objection to either one. The benefit, in my opinion, of the synthetic is it continues to allow for upward momentum of the market before you begin to have to increase your margin requirements or go into a realized loss, which would be above 137. So it gives you just a little bit of room from where we are, about $7.50 higher, that you can still trade before no realized losses are made in this market. So I like this particular trade better than I do the synthetic put position, than the bear put spread right now, because I think the upside is limited. I think it's limited to about that August high. And if you see where I've got the top trend line drawn at the 137, and that's the call that I sold, well, that's right up against the August highs. I think that will be about the extreme that we could see for the August highs. And if we flip back real quick to the feeder cattle contract, we can see 137.42. That's right, those two lows right there that we saw back in 16, in June and July of 2016. So we have some other, from the weekly standpoint, we have some other prices that are beginning to reflect that 137 area. So the 137 area becomes the area that whether we exceed or not, it doesn't matter. What we're looking at is that's what we think that the market might be able to trade up to. So therefore, that's where I use the sale of the call option. Both of them have the same premium out of pocket. The difference being is you will have protection all the way down to 0 with the synthetic short futures. You will only have protection down to 120 on the bear put spread, and at 120 you would have to make a second decision. Do I need further downside protection in this market in order to keep from prices going against me? So that is another equivalent that you might have to look into if you do the bear put spread. You might have to make a second decision. With the synthetic short, you wouldn't have to make that second decision. Your second decision would only come whenever you got ready to market your cash inventory. That's your second decision on it. On the fat cattle market, I really wasn't real fond of either one of the synthetic shorts. And the reason being, in the April contract, we could still experience some kind of weather problem, something out of the ordinary from the lower placements that we had all the way into the October time frame. So October, November, December, January, February, maybe lingering. If weather were to turn bad, we could get those cattle to not perform as well and push that April contract up higher. So if I were going to do anything in the April fats that I had to appease a lender, if I wanted to have some kind of protection on regardless, I would just buy the 116 put. 116 was the previous high that we saw before today's rally. That could end up around 2 and pay 282 for it. Now you're down to a 113.12 minimum sale price, with the upside still all the way open. In an instance that we were to have some kind of weather phenomena, some kind of something that were to push the April contract above 122, then I might want to look to sell a call around the 130 area. It would not bring in much, but it would reduce that put premium that we had some, or try to make a cash forward contract. Try to always be on the upper end to try to make the cash forward contract over selling another call, because then your risk is eliminated totally from there. Same thing on the June contract, and I would even go way out of the money. I would not even do anything but buy the $100 put in the June for a just-in-case Hail Mary if something horrible happened, giving you a 98.22 floor. That probably won't break even. It might even lose a little money off cattle for most people in this time frame. If it makes money, then all the better. But again, you're dealing with a basis right now on that on the June contract, $10.80. I can work a lot with $10.80 of where we sit in cash right now versus where the June is versus where it might go under a worst case scenario. Under a worst case scenario, I've got a $100 put there that solidifies that floor, giving me 100% opportunity minus the $2.82 that we paid for the, the $1.77 that we paid for the put, all the way up to wherever the market ends up at. Which on the June contract, if this thing really gets going, you could see 110 to 112. That would not surprise me. And what you may see still is significant spreading through the year. You could see consistently buying of the back months, trying to take advantage of the discount to it, and the front months more susceptible to anything current in the cash market, where you may see April dive $2 or $3 and June only go down 50 cents. You could see that through most of the year, where the front end is consistently taking the actions of the front spot month or spot cash, and the back months continually finding some favor in there due to their discounts. So we've seen the recognitions of the changes. We've got fewer cattle on feed. That's going to change. We're probably going to start having more cattle on feed since November placements were higher. More likely than not, December placements will be higher. Not real sure about January and February. We'll get new information on the herd health on January the 31st for the inventory report. I'm not as familiar with what feed yard objectives are for trying to keep weight off of cattle. It has been rumored that more than likely than not, those were individual cattlemen that held those cattle for too long, that kept them up too big. Maybe what we have done is turned a mindset now, and that mindset is most can see when you overburden this particular situation with inventory, price drops pretty hard. Let's make a conscious effort not to overburden this industry right now with too much inventory. We can't really keep the numbers down, but we can clearly keep the weights down off of this. We got improved demand. I anticipate that demand to continue to improve because the restaurant index had been floating around the 100% level. The restaurant index gauges the health of the restaurant industry. Above 100% it's growing, below 100% it's contracting. It has hovered around 100%, with November having it up to around 102. They need to be aggressive to bring clientele out of their own kitchen and back into the restaurant's kitchen. We saw some price discrepancies between eating at home versus eating out. Those discrepancies got wide. I have seen more and more advertisements come about lowering the price of menus or offering features 2-for-1s in order to lure that consumer back into the restaurant. That should be pretty beneficial towards the beef market. We're having a little bit better exports, and as of today on the midday cattle comment, I wrote that I think we've seen a top in the U.S. dollar index. Whether long-term or short-term, I think we probably got 2-3 months of lower U.S. dollar trading. Depending upon what currency market you are looking at, whether that currency excels or not, I'm not real sure. But because the dollar index is primarily weighted towards the euro currency, I believe the euro currency has bottomed, and we'll start to see more abrupt move to the upside. That will help in other commodities, and that will clearly help any kind of beef exports that we may have, because it will start to make those beef exports just a little bit less expensive, and that will help more because now we've got a rise in price. The mentality of the producer is not probably going to change this year. However, I will urge you to not try to be overly aggressive in hedging, and to actually speculate just a little bit on this year's. massive capital was lost over the last 2 years, I don't think we're going to see price ranges the same as what we saw, so it's going to be much more difficult to make that up in the shorter period of time. So I think you have to have every advantage that you can get on your side to be able to make money, and the unfortunate of that is you got to take some risk. I understand that risk taking right now is a sore subject, but I really believe that if you were going to excel this year and try to be above the rest, I think you have to take some risk. Take calculated risks. When you apply hedge strategies, you may or may not win, but you will not lose the farm if the market goes down hard. If the market goes up, you're going to replenish that lost capital at a much faster rate. But again, one thing, don't anticipate big, wide price ranges just yet. There is nothing bullish in this market. There is still enough bearish to knock down a 50% retracement of the gains. So you got to keep astute to it right now because there's just nothing really bullish in this market, and the price ranges should remain relatively narrow. Try to keep in mind you're going to carry a positive basis through the majority of this year. I don't see any reason whatsoever for the futures to all of a sudden garner impressive strength to pull it over the cash market with expectations of the cash market moving up to futures. So don't expect that. I think that the strategies that I provided this afternoon in the March feeder cattle, tonight, when I'm not barking in your ear, you can convey those same strategies to the April and May contracts using the August high of 16 as your point for the calls to sell if you're using synthetic. And then whatever premium, that premium you want to do is all adjusted by whichever strike that you buy on the put or sell on the call. That's what makes the adjustment for the premium there. On the bear put spread, if that is more your fashion where you are not assuming any kind of risk except for the premium that you pay for it, as well as providing yourself unlimited upside potential on anything, then the bear put spread may work for you. But just remember, you're going to have to make a second decision on the bear put spread if something were to materialize to start taking you below the bottom end of that strike price. So I'm going to open it up for questions. And I would also like to say that at the end of this, there is a survey, and I would greatly appreciate you filling out that survey. I enjoy doing these. I want to bring you good, solid information and information that will help you, so your feedback will help us to be able to do it. I really appreciate Chris Windward's help this afternoon getting this program scheduled, getting it all up and running. It's been a fantastic help to me here. I know many of you that call into office talk to him now, so a special thanks to him for getting this up for us. So I'm going to turn it over now to some questions. I'm going to click a few screens on here so that I can see those questions, and I'll hang around for as long as you want me to ask these questions. So. And Chris, do they know how to? Does it show on there how they can type those questions in? Okay. Yeah, it looks like there should be a bar on there that you should be able to type your questions in on. All right. I'm not sure if I'm not seeing any questions pop up. Oh, here we go. Thank you for the insight. All right. Okay, found the bar to ask the questions. All right, here we go. All right, seems like pretty questionless, so I've either bored you to tears or maybe provided everything under the sun that I can. So I will say this, anytime you have any questions or anything, feel free to give me a ring. Just pick up the phone and give me a ring. I'll be glad to help you in any way that I possibly can. And I certainly do appreciate you taking the time to attend this, and we'll look forward to doing business with you in the future. So I certainly do appreciate it.